Moving right along in chapter 5, we got to learn some rules. All right. And what we're going to learn is how to journalize merchandise transactions. So once you learn the rules, it becomes relatively easy. You just got to know the rules. First rule we want to know. Take 30 seconds and turn to your teammate and tell them the difference between the periodic method of calculating inventory and the perpetual method. Tell them everything you know about why it's different. All right, did you amaze your teammate with your brilliance? What's on my hand? My hand. My visual aid. All right, so you should have turned to your teammate and said, well, if we use the perpetual method, we do both of these methods to determine our cost of goods sold. Under the perpetual method, it's done automatically for us. Every time we scan something, it updates our sales, updates our cost of goods sold, and takes our inventory lower. All right. Under the periodic method, we don't know this number until the end of the month when we go out and count inventory, and then we plop it into our formula. You all know the formula, right? We showed you the other day. You have that written down? Should be emblazoned into the walls of your brain. So whenever we're talking about periodic, we're going to be referring to that. All right, there's good news and there's bad news. The bad news is that the rules under the periodic are completely different than the rules under the perpetual. The good news is that in this class we're going to focus solely on the perpetual method. I'm not going to confuse you with periodic. If you want to be confused, come to bookkeeping 1 and we'll go through all that and we'll show you the differences. But for right now, we're going to focus on perpetual, which is good. We only have to learn one set of rules. The other rule is that under this formula, even though we don't use it, I'll use it for that. The other good news is that under this formula, we've got this word called purchases, which is increased with purchases and freight and decreased with purchases, returns, allowances, and discounts. We don't use any of those words. We use this master account called merchandise inventory. We know that's an asset, right? So merchandise inventory is increased with purchases and freight, and it's decreased with purchase, allowances, and discounts, returns and allowances, and purchase discounts. Yes? Our accounts are continuously updated, and we can determine our cost of goods sold at any point in time. All right, let me see if I can get to this slide that I want to show you. Down the way here. I don't know why they put it at the end, but it'd make it a lot easier if they put it at the beginning. Oh, come on. Where did it go? maybe it's under the periodic list. All right, well, sorry about that. I thought I had that slide. Must be someplace else. All right, so what you want to write in your notes, under the perpetual method, we don't use any of these words. What you want to write in your notes is under the perpetual method, we call everything, when we buy something, we call merchandise inventory. And we're either going to debit the account to increase merchandise inventory, or we're going to credit the account to decrease merchandise inventory. We don't use any of these words. The word we journalize is merchandise inventory. That's what you want to remember. Okay. So that makes life real easy. We're only going to focus on the perpetual method. All right. The other tough thing about this chapter is that you have to determine, when you're doing these journal entries, you have to determine whether you are a seller or whether you are a buyer, because the rules are completely different than if you're a seller or a buyer. And that's what we're going to go over in the next 20 minutes. We're going to be a seller to start off with, so you got to put your seller hat on. I like my visual aid. All right. Here's the journal entry. We sold $1,800 of merchandise for cash. Should be no problem for you, right? Cash comes to us in asset increasing, revenue increasing. You all knew that just like that, right? This is where the rules of debits and credits are extremely important, because if you're standing there going, haba, 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 go home and practice your flashcards. If that was immediately emblazoned in your brain that you knew what to do, you're good, doing good. All right, under the perpetual system, the cost of the merchandise sold and the decrease in merchandise inventory are also recorded. The cost of the merchandise sold on January 3rd is $1,200. All right. So whenever we sell something under the perpetual method, there have to be two journal entries. One is to record the sale, that's this one, and one is to record the cost of the sale, what it cost us. We sold it to the public for $1,800, but we bought it from the manufacturer for $1,200. So we made a nice $600 profit right there. So here's the journal entry. Cost of merchandise sold. What kind of account is this? Expense. How do we increase an expense? Debit, right? And here's our merchandise inventory. So when we sell something, what happens to our inventory? What does the computer do? Put it in or take it out? Take it out. How do you make an asset go down? All right, so that's where we're getting at. So that's why 30 years ago, before we had these fancy computers, not many people use the perpetual method because it's cumbersome. You had to journalize every sale. You had to journalize two entries. One to record the sale, one to record the cost of the sale, and deplete inventory. Nowadays, it's the scan of a button. And credit cards, we're not going to worry about. But sales on account. So on account means that, what? Yeah, no cash transpired, right? So account means either we owe or people owe us. Well, if we're selling on account, people owe us, right? So instead of cash, it's accounts receivable. And our cost was $280, so we're going to increase our cost to get sold, and the computer's going to take it out of our inventory. That's it. Seller hat. Seller journalizing a sale. Two journal entries. How about sales discounts? The terms for the payment of merchandise that would be made are called credit terms. All right. We said that a discount, sales discount, is the we're offering the buyer to pay early. So and it's going to be on the invoice someplace. Here it is, right here. There's the terms. 210 net 30. Anybody know what that means? Excellent. Where's Fleece? Wake up, Fleece. Megan did a great job. Here we go. So she was mumbling over there, but she said it correctly.
What was it?
It said that if you pay me within 10 days, you can take a 2% discount. If you don't pay me within 10 days, the whole thing is due in 30. And this is the seller. The seller is offering this to the buyer. So the seller can put whatever terms he wants on there. 115 net 30. Maybe his payment terms are 45, so it'd be 210 net 45. And again, why does the seller want to encourage you to pay early, Darryl? Cash is king. Right. He who has the cash is king. All right, so that's the term. So to encourage the buyer to pay before the end of the credit period, the seller may offer a discount. The 210 net 30 just means that the buyer has a 10-day period in which to pay the amount. And so how do we handle that? Here's the journal entry. This is, again, seller's hat on. Right? So the bookkeeper opens up the mail. It was, oh wow, Omega Tech sent us a check for $1,470. Hey, wait a minute, they bought $1,500. Oh, that's right, we offered them a discount. So all you do is take the amount that they owed us times 2%. And we remembered the other day, this is sales discounts and allowances, or what kind of account? What increases them? And it is a part of revenues. So if the rules are flipped, it's called a contra revenue account. These are contra revenue accounts. Remember, we've got sales, discounts, sales, allowances, all right? Debit to increase, credit to increase, all right? So they have the effect of reducing sales. That's what it's doing. And we put it in separate accounts so we can keep track of it. All right, so our cash is increasing, our sales discount is increasing, and the amount that they owe us is going away. Accounts receivable going down. Seller's book, seller hat. When we get to the buyer, it's handled completely different than that. So that's the confusing part of this check. So we're authorizing a credit memorandum. Basically, this would be a return of some type. So here's the story. We're going to return merchandise to the seller. The value is $225, and our cost was $140. Seller. All right, so sales returns and allowances we're debiting because we know that we're increasing that with a debit. It's a contra revenue account. The amount that Crier owes us goes away. All right, so that records the return. Under the seller's hat, we also have to put it back into inventory at our cost. All right, so that's an asset increasing. And our expense isn't as much as what it was before. So now our cost of goods sold is going to go down with a credit. Expenses decrease with a credit. When somebody returns something to us, we're just flipping the original entry right here, right? When we sold it, we increased cost of goods sold and we decreased inventory. Well, when they send it back to us, we're just going to flip that, put it back into inventory and decrease our cost. All right, let's see if we sold merchandise on account, $7,500, terms 210 net 30. The cost of the merchandise was $56.25. 2 journal entries, one to record the sale, one to record the cost of the sale, and the depletion of inventory. And then 10 days later, because it looks like they're taking the discount, 10 days later they send us a check. How much are they going to send us? Well, they owe us $7,500, but we offered them a 2% discount. So $7,500 times 2%. And so they're going to send us a check for $73.50. We're going to recognize the discount, and we're going to remove the receivable off the books. All right, so if you're all on practice exercises for Chapter 5, do 2A and 2B for practice. See if you can. 2A and 2B.